Yes, I can hear you now, yeah. Oh, no problem.
I can. Hello. That's all right.
Yes, I can. How are you? Good afternoon, everyone.
I'm Harriet Formby. I'm a fractional CFO and founder of Below the Line Finance. I work with primarily creative and values-led startups who are serious about growth but don't want to lose themselves in the process. So my role isn't just to organise the numbers, it's to turn your finances into a powerful tool for decision-making, direction and momentum.
Hi, I'm Sophie. Thanks for having me. I'm the founder of Right CFO. We're a firm of fractional CFOs. There's 10 of us, of which I'm one, which means we provide experienced CFOs to businesses that need senior financial expertise. More recently, we started offering CFO consultancy by the hour for businesses needing more flexible support, as well as dedicating like mentoring for startup founders while they're in the early stages of growth, and providing remote financial controller and booking support as well, just to complement. We work with tech, creative, media, and not-for-profit businesses.
Hi, thanks for having me on. My name is Samuel Ajala. I'm managing partner at Arthur Hammett and Accountancy, and I'm also the founder of ScaleUp CFO. And there, what we do is provide fractional CFO services to many startups, especially in the SaaS and the tech space as well. I help founders optimize cash flow, reduce burn, and get investor ready. Whether that's building a financial forecast, setting up a SaaS metric dashboard, or supporting generally through fundraising. That's pretty much what we do in a nutshell.
So I'd say in terms of don'ts is I see a lot of people making quite big kind of investments, for example, in maybe, the website setup or the tech functionality. They get something built before they've actually tested it's what they need. So I'd really sort of say be scrappy with testing ideas, iterating as you go. Don't make investments and things that are going to be maybe redundant in 6 months' time. And on the do side, I would say, if I just sort of narrow it down to one thing, is even if you are early stage, do have some sort of financial plan, financial model, even if it is following a template and you're not in a position yet to kind of work with a fractional CFO. Do make sure you've got that in place, because it's easy to get distracted by the shiny fun stuff, the marketing, the networking, the building, without actually looking at the viability of your business, getting it down on paper, working out your moves going forward, and starting to see what isn't viable.
There you go. Okay, so my do is a really easy one, is to register for VAT right away. And a lot of people don't, because there's a threshold, you don't have to. However, if you're just starting out, you're probably spending and more than you're bringing in revenue, and you can get 20% of all those costs back if they're VAT costs. So I would definitely do that. My don't is when you're bringing in external help don't just, get a mate. Because I've seen this several times where, they need some financial help. They need maybe fractional CFO or FC or something of that nature, and they go through a process, and then one of the investors has a mate, or one of the chairman has a mate, or the entity has a mate. He knows something about accounting, and suddenly I know it's important to have that kind of trust, and there's an element of it's a bit like asking for a referral, but suddenly that's prioritized over whether they can actually do the job and do what you need to be done. So I wouldn't be kind of I don't know what the word is, but like blindsided by that.
Want to comment both those points. I think my do's for founders is really get to know your numbers. For me, I think there is a lack within this space, the startup space, where a lot of founders are not necessarily, I want to be very nice with my words, but financially literate, right? And just being able to know your numbers. So the first do is do know your numbers. The don'ts is, again, linked to numbers, and don't confuse things like revenue with runway. Again, it's still linked with what I mentioned earlier about knowing your numbers. And I think it's very important, especially in the presence of investors, that even in the eyes of investors, they actually believe and know that you understand your numbers, which in turn will give them the confidence to invest in you.
Okay, those are some very good points, and thank you very much to all three of you for that brilliant wisdom. Now, I think we can go to some questions in the second. I've put 2 questions in the chat just in case if my panel would like to read them. But in terms of, so I keep getting this, and I think we keep repeating this almost every session we do, but most places I go to in terms of events for startups, one of the questions I always get is templates. And of course, I understand that being in your business, you'd rather, it's a bit like lawyers, you'd rather have people that come to you for those templates so that you can work it out. But are there any sort of really simple things in terms of templates that you would suggest founders have at the ready? And do you know any platforms out there that they can get them either for very low rates or for free? Any thoughts on that? Perhaps we can start with Sophie this time, then Harriet, and then Samuel.
Hi. So in terms of templates you can just get online.
Exactly. Those the ones that I'm talking about. Anything or any place you've seen any half decent templates, and which ones you think founders should normally have at the ready, no matter what?
I mean, to be honest, I haven't found any good ones. I found some bad ones. And I've tried some kind of AI. I've tested some AI.
All right, let's talk about the bad ones then. That's okay too, Sophie.
Yeah. No, you put me on the spot.
Obviously, you don't need to mention the names.
But yeah, I did one where they wanted me to test out. It was really for financial modeling, but it was for to do like a 5-year forecast. And I think that the thinking was right in that, they wanted you to say what the drivers are and what your growth rate is going to be and all this kind of stuff. But actually what it spat out was, I did it as a practice for my own business, and it said I was going to make 5 million in a couple of years, which I'm not going to do. And it was just, it was not reliable. So I think there's some dangers there of using some of these things. also, it is very much, especially with, if you're forecasting, it's very much specialized in what you provide. There is going to be specific driving things, drivers that push your business and create revenue, and they're going to be different for everybody. I've created loads of these kind of things, but I would get a person, any of us on the panel or anyone else, to create a template based on your business, and have it so that you only have to change the drivers, and it just works itself out afterwards. But there's a lot of people working on this kind of stuff. There's a lot of AI people working on AI driven models, but I have not yet seen one that I like.
Fair enough. Thank you very much. Yes, Harriet.
Yeah, I'd say similar to Sophie. Often people come to me and they sort of say, look, I've started this model and now the investors have said, we've got questions and they picked it apart and I need to build, expand it and make it better, start from scratch, whatever that might be. And I would agree, they tend to be, quite complex. There's lots of tabs, lots of things going on, but they tend to, extrapolate quite rapidly in a way that looks very nice for vanity metrics, but isn't necessarily sort of grounded in reality. I would say I tend to prefer to, which isn't very helpful from a template point of view, but for a startup, kind of do something more bespoke that factors in, the industry, the drivers, various things. So I would say the one that you really maybe can't go wrong with on a template approach would be, cash flow, because that is a bit more, you can have a structure. A cash flow template would be really good because you've got the structure there of the inflows, the outflows. It's going to prompt you what to consider, timing, VAT impact, when you might need investment. And that's going to be, if you haven't got the ability to go and, get something bespoke done. And I know it's obviously cash flows for a slightly different purpose than a financial model, but that would be something I definitely say is worth, using a template for, because it's going to point to you when you need to, what's coming up, when you need to react. And that's something you should be able to get. I've got a few that I put out for free and stuff like that with the cash flow templates. But it's fairly straightforward. But that's something you can definitely, people don't tend to go wrong on that. And if cash flow is tight, then I would be doing it on a weekly basis, and having something that you're really kind of plugging back the numbers in, almost dipping into it weekly as well, and making sure it's up to date. So that's one that you definitely can get a template for and stick with.
Fantastic. I think the 2 points that have been mentioned are fantastic. In fact, all I will be doing is buttressing and re-emphasizing the points that they've made. If somebody was to approach me now and say, what's the one tool they need? Without doubt, as has been mentioned, I would say a cash flow forecast. Probably more of a 13-week cash flow. One of the things that a 13-week cash flow, so looking really at 3 months, it lets you basically know if you're running out of cash and when, right? So it gives you visibility of the cash position on a week-by-week basis. I think one of our panelists mentioned the importance of looking at it on a weekly basis, and it makes you sleep better at night. That's the truth, right? So we're assuming that the startups we're talking about here are maybe under 500,000. And so in most cases, I could suggest tools, softwares, AIs, and things like that. At that point, I think what you really need is something basic, right? Everybody knows that oxygen is the lifeblood of your business. And if you run out of cash, then it's going to be a problem, right? So your eyes needs to be pretty much on that. One of the things, for example, it highlights is the cash into your business. So you can look at maybe are the invoices being paid on time or not. And it lets you act early. In the next month or two, if you feel that there's going to be any bumps in the road, you're going to run out of cash, then it allows you to reduce maybe the number of expenses you've got, which allows you to reduce the burn of the business. So I pretty much say a 13-week forecast. Now, for anyone that's operating above that or do more complex things than that. You've got activities such as software such as Float, Fathom, even Power BI. But yeah, just buttressing the point, a 13-week forecast without a doubt is almost mandatory. The reason why I say that, because even as a founder, you can pretty much manage that yourself if it's a very basic one. Ironically, I had one of our clients actually requested when I put one together for 13-week forecast. And so if anybody needs it, I could drop you and Tim the link for anybody that needs it. But it's very basic. You can easily manage it. And it pretty much tells you on a quarterly basis and a 13-week basis whether you have enough cash in the business to continue with the plans that you have.
Well, that is amazing. Samuel, if you don't mind, on LinkedIn, on my last post, you'll see I'm probably the last person that has tagged you. It's our live stream, so where people are watching this live now on LinkedIn. If you wouldn't mind, in the comments of that post, to leave that website link for that 13-week forecast, I think that would be amazing. If you don't mind doing that. And whilst you're doing that, we'll go back to the ladies, because you brought up a good point here in terms of tools, and we've discussed this in our previous sessions, but if my panel doesn't mind, we'll perhaps just remind people of a few tools again, a couple of tools each, if you wouldn't mind, that you think are crucial for any startup. And I'm talking here, you know, the ones where there's 1 or 2 founders and maybe there's only, I don't know, 2 up to 10 people, not more than that yet in the company. What are some good tools, either free or quite cheap, in terms of managing finances? So again, we'll go to Sophie, then Harriet, and then after that, hopefully Samuel would have posted that, and you maybe can give us a couple of tips on that as well, Samuel. Sophie?
Hi. So the first one will just be that, and this might seem very obvious, but you need an accounting system. And I recently took on a new client who is doing well, and is kind of global, and they didn't have an accounting system. I was quite shocked. Everything was on Excel. So get yourself an accounting system. I would suggest Xero. I think Xero is amazing. It's cheap, and no matter what you do, you know, there are a million plugs in for it. That, you know, whatever you do, product, service, doesn't matter. Timesheets, you can add a plugin for that. It's really, really versatile, and very easy to use, because it is for smaller kind of businesses. There isn't this kind of element where what I mean is the bigger accounting systems, you make changes and there's this audit trail, and Xero doesn't have this. It's really intuitive. So that's my number one. I think someone mentioned Fathom, which is also I'm only just starting to use, and I'm still getting my head around it, but it's quite good for reporting. I mean, yeah, 1 or 2, 3 people in the business. I don't think you need much more than Xero and Excel, actually. Just make sure that you have your Xero set up properly so that all your bank transactions automatically get swiped in, and just minimizes effort.
Hey, thank you very much for that, Sophie. Harriet, 1 to 10 people, what are your go-to tools that you recommend? A couple of them, if you can, please.
Yeah, absolutely what Sophie's already said in terms of, yeah, using a system. You know, I would echo Xero is good, and Excel does a lot of things for you. I'd say, you know, if I'm thinking of other things, probably, you know, making sure that you've got, obviously you're going to have a bank account because you're going to need one. You're probably a limited company, so that's a given. But having a system, you know, set up, and you can do this with things like Monzo and Starling, where you've got the ability to create pots or maybe separate accounts. And if you're on, you know, a high street bank that isn't quite as technically good on the apps and interfaces, but make sure you've got the ability to, you've got the cash, looking after the cash flow and planning it on, a spreadsheet is one thing, but actually, making sure you've got the money set aside. So we're talking about like when you have money in the main current account, being able to put it into, a pot that's building up, for example, for VAT or taxes or for, whatever it is, so that you know how much money you've really got when you look at it in your bank account. So I'd say, that's a fairly simple one. It's just using the tools that are usually available with your banking setup. And the other side to that is it does give you continuity then, because if you do have, for example, 2 banking providers, then if something goes wrong, somebody's system's down for the day or maybe longer, it means that you have not been cut out of your funds. You've got a bit of balance that you can still access, funds hopefully for essential payments.
I don't know where to start with this. For me, honestly, I do love tech. I love automation. I love streamlining processes and business. I do like exploring softwares a lot. With regards to Xero, right? I feel that as long as you are your record keeping is clean, right? There are so many reports that you can download for yourself. So many comparable reports as well. So you can look at your first quarter in 2025 and compare it to 2024. So that pretty much tells you how you are operating as a business, right? Year on year in how this first quarter compares to last year, to see if you're making progress or the things that you need to adjust or review, right? But for me, cash is king, right? And so, as was mentioned previously, a lot of these softwares now have the integration with bank feeds, which means that these softwares basically connect directly to these bank feeds. And even with Xero, I think it even automatically reconciles, especially if they're matching, reconciles some of these transactions. You need to reconcile as early as you can, right? Because what you'll find in your profit and loss, you'll see that you've got maybe a large profit, but it's not reflected in your bank account. You need to ask yourself the question, why? Is the reason why people are not paying on time? They're not paying within their 14 days or 28 days period by which they're supposed to pay that invoice. Cash is king, especially early on, especially before you get funding. How am I getting the cash into the business? And early reconciliations with the help of some of these softwares, pretty much is inevitable, right? In addition to that, because I said cash is king, anything that helps you bring in the money quickly as possible is always a positive. So softwares like Stripe. Now, whenever somebody's paying off an invoice, you need to give them as many options to pay so that there's no excuses or no delays in the payments. So you need to give them as many options. I love Stripe. I love the reports it provides. And I love it even as an option for people to just pay with their credit cards or their debit cards there and then. And also you've got the options of Gold cardless, of setting up direct debits into the business. Again, I keep heaping on cash is king. So I may be biased to any software that enables you to quickly get the cash into the business. But yeah, I don't want to bore you with some of my tech know-hows, but I think the ones I've mentioned right now as are imperative to use. You've got QuickBooks as well, which is equivalent to Xero. You've got also Dext, which helps you scan receipts and quickly uploads it into Xero. And then you've got a software called Zapier, which helps you plug into Xero and to QuickBooks. A lot of these other softwares that plugs into Xero or QuickBooks for quick automation. Yeah, Anton, let me not bore you too much.
No, you're not boring us at all, actually. Quite the contrary. Thank you very much, all three of you. And just a quick mention in terms of Zapier, although it'd be good to get them as sponsors, and then we would do this happily, but Zapier is actually really good for automation of all sorts of things, from web development to operations to finance to you name it, they've got it. So yeah, that's pretty useful. Okay, we now only have 21 minutes to go. So if we can, let's try and keep it to about a minute each. But we've got some questions that were sent in. And by the way, if it's not your bag, it's much better to say, this isn't my thing, I'll pass. So don't feel forced to answer questions, please, panelists. But we'll go through them and we'll try and spend about a minute each with your answers. So we'll start with the first one. This, and by the way, just before that, actually, just a quick reminder, because I see my phone pinging on various social media platforms that we're streaming this. So whether you're following us via LinkedIn, YouTube, Facebook, or Instagram, please be aware that unfortunately we're unable to monitor your questions there. So if you do want to ask us anything, you would need to be here with us on Microsoft Teams. The quickest way to do that is go to our website, startup-to-scale-up.club. Look for today's session, which is Startup Finances Q&A 03. Click join. It's a quick registration. Then that gets you a link to your email, and you can join us via that link. It's audio only. And once you're here, then you can type your question in the chat. There are no wrong or right questions. And those questions, by the way, can be on anything to do with finances, from your cash flow, budgeting, profits and loss, payroll, taxation, bookkeeping, VAT, auditing, credits, loans, banking, frauds, projections, forecasting, and so on. Literally, there are no wrong questions. However, if your questions are on other matters and not finances, then please save them for the other events we run. Monday's talent, Tuesday's product and tech, Wednesday's growth, Thursday's fundraising, second Friday of the month is UK startup law, and third Friday of the month, i.e. today, is UK startup finances. They're all from 12 to 1 p.m. UK time, and you can RSVP to any of them on our website, startup-to-scale-up.club. And actually, when you're there, you might want to join our WhatsApp community, which is groups of founders, investors, operators, and all that stuff. So we'll now go on to our first question. This is in Aberdeen. So we're handling revenue forecasting for market disruption. What? Okay. Sorry, startup type. Okay. Agritech startup introducing AI-driven crop monitoring solutions. We're based in Aberdeen. The challenge we have is that the company is launching an innovative product in a market where traditional solutions dominate, making forecasting adoption rates challenging. The situation we're in is that we're pre-revenue, bootstrapped, with initial pilot customers secured. So my question is, as an agritech startup entering a market dominated by traditional methods, how can we create a revenue forecasting model that accurately predicts adoption rates for our innovative solution? What specific data sources, such as DEFRA reports or industry benchmarks and forecasting techniques, Jesus, what the hell is that, like Monte Carlo simulations, should we incorporate to build scenarios that account for market inertia, regulatory shifts, and initial traction? Boy, this is all great to me. Let's start with Samuel this time. Then we'll go on to Sophie and then Harriet, please. Any thoughts? 1 minute each, please.
Thanks, Anton, for the question. Without much data that they have in-house, right, what they need to do is look at the market and see how the market's performing, right? They said they've had a pilot. So what they can look is what is the average conversion rate in that market. Their experience with having their small groups of pilot, what is it like to, how many leads, how many customers do they expect based on their activities, and then they can now make comparison to what's happening in their market as well. Without them having their own numbers, it's quite difficult for them to make that forecast. So they have to look at the wider market, right? Yeah, that's it in a nutshell. You have to base it on activities that's happening in your market, use or fixed numbers that are occurring in the market. So it's going to require them to do quite a bit of research in order for them to base some of their activities on. And if I'm honest as well, from their pilot sample, even from their pilot sample, they can draw some kind of forecast based on the numbers that they have already. But beyond that, there's not much they can do from their own activities. Yeah. So that would be my advice in a nutshell, for them to really do their market research and base it really on the activities of their market.
Thank you very much, Samuel. I think the next one was Harriet, if I'm not mistaken. Harriet?
Thank you. Yeah, I think so. Just for kind of context, I suppose sometimes how you might approach this, and this could be any sector, is almost to say the total number. For example, this example, it would be to say the total number of farms are this, and therefore we think this percentage will adopt, you know, the technology, etc. And I see that quite a lot extrapolated in models. It says this is the total market, we're going to go for 5% share, and then, you know, creating huge big numbers that come out of that. And I think that can be quite misleading because it doesn't reflect what, you know, the underlying things going on in the industry and all of the kind of nuance to it. So I'd say that's, you haven't said you're doing that. I'm not saying you've said you're doing that. Obviously you haven't said that. But I think, you know, the real thing there is, you know, yes, you can get into all these techniques and modeling and various stuff that's very sort of scientific and high level, and you're trying to then make very precise data out of something that isn't necessarily grounded in the real world. So I'd say, you know, and this is talking, I guess, if you're, you know, speaking to investors, they want to be confident that what you're coming up with is grounded in reality. So I think, you know, in terms of, yes, it's really good to go and look at like DEFRA reports, benchmarks, what's going on in the legislative world that's going to push people to different things. But I would be almost thinking like localize this, because I know if we're talking about the UK, I guess different regions in the UK even have different, and this isn't me talking as I know, as though I actually know what I'm talking about with farming, etc. But I would imagine there's very different conditions in different parts of the country, which mean that crops are more relevant, you know, different types of crops, different methods are relevant in different areas. So I would be kind of localizing it if you can to a region, you know, to specific regions, and then actually talking to people. And it might be even if you can get, you know, if there's some big farms that will test this for you, and you say, you know, actually talk to them and, you know, get them as a really warm lead or as a pilot or something, and actually then make decisions based on, you know, people that you've actually spoken to. You know, there's some really big farming businesses out there, and not everybody's, you know, small farms, family owned or whatever. There's some really big, particularly in the crops sort of space. So I would be kind of, yeah, getting as much real world data, real businesses as you can, because the models aren't necessarily going to, they'll give you what you want to see maybe, but they won't necessarily bring out what's actually going on the ground. And, you know, ideally, I guess you want to start getting, you know, this used with people and have some farms on the system or whatever, and then from there it will extrapolate, I guess. So hopefully that's helpful anyway.
Thank you very much, Harriet. Last but not least, Sophie, your minute starts now.
Okay. Yeah, I think both Samuel and Harriet's advice are really good, and I agree completely with what they've said. To add to that, I mean, you know, is there a model that's going to give you accurately predict? No, absolutely not. Because this is innovative and it's, you know, market disruption, and you don't know what's going to happen. But what I would do with the data you collect is then have a worst case, best case, and a medium, you know, scenario. Have 3 scenarios, and that might, you know, just give you a little bit more honesty and to yourself and to investors or whoever this is reading this. And yeah, don't spend all your time trying to accurately guess, you know. And I think just get on with it without sounding rude. But yeah, you know, and the pilot will give you wonderful information. The surveys are good to survey the your target market, but yeah, I don't know what a Monte Carlo simulation is. I don't know what some of these things are that were listed in there, but do what you can to get all your data and just do 3 different scenarios. That's what I would do.
Thank you very much for that to all 3 of you. That is some brilliant stuff. We've got 2 more questions to go. If we can answer them, it would be nice, but if not, we'll at least start with this one. So this is, where is it? Okay, so StartUp, it's a SaaS startup providing AI-powered CRM tools for SMEs. They're based in Manchester. The challenge that they have is the founder directors work as employees, but also take dividends, creating complexities in PAYE and NIC compliance. So our situation is that we're bootstrapped with a small team of 3. So the question is, as founder directors balancing employee salaries and dividends, how can we structure PAYE and national insurance contributions to optimize compliance and minimize tax liabilities? Also, are there specific thresholds on tax planning strategies we should prioritize to ensure accurate filings whilst preserving cash flow for growth? Question is in the chat in case the panelists want to see it again. But maybe with this one, we can start with Sophie, then Samuel, then Harry, please.
Okay, so this is a really common setup where the director or owner will be on payroll, but it would be the minimum amount that you could have as salary, so you don't start paying tax on it. So say the thing is, it changes. There are thresholds, but it changes. So I don't know what it is at the moment. 12, 14. I can't remember what it's changed to. It's recently changed. So you have that as your payroll, and they probably have a payroll provider, an accounting firm that they use. They will know whenever it changes. I do this myself, and my payroll changes every year depending on whatever they think is best tax wise. So you get say it's whatever, £12,000 a year you give yourself on salary, and then you take dividends. So the important thing is you can only take dividends out of the company if the company is profitable, so it's profits after tax. So people do this in different ways. You either wait till the end of the year or half year or whatever, and you see how the company's doing. You make a calculation, what is doable, and then you take a dividend out. Some people do it every single month and put it, just post it into kind of director's loan account. A lot of people do that. There is a risk that you're taking more out than the profit you're making. So you have to really look at the numbers and make sure you're not taking too much out. But in terms of the exact thresholds, just ask whoever does your taxes. Ask them, because it keeps changing.
Sorry, is it me speaking next? I wasn't sure. Sorry.
Yes,
Sophie,
sorry. I was trying to do something in the live streams, but yes, sorry. Go ahead, Sam.
Fantastic. Sophie made an absolute valid point. So the threshold, the tax-free threshold for income is £12,750, right? And that usually is around £1,000 a month. But with that amount, you're still going to be paying national insurance, right? So usually your income will be slightly less, about £840 a month, right? That way you avoid both income tax and your national insurance, right? Now, the reason people do this combination is that up to £12,500 is no tax. And then above that on your PAYE is 20% tax. But if you take out dividends instead of salary above £12,000, you're only going to pay 8.75%, right? On your that's the percentage on your dividends. So this is why people do the combination, because that way you'll be paying a lot less. What I would say to you is this: when starting a business, there's going to be a sacrifice, right? You're not going to be able to take out huge amounts. You know, some of these movies make it seem like, oh, having a business, you become a millionaire overnight. No, but I think one of the things you can do as an owner, right, and even as an employee, you can actually request this as well, is maybe some kind of share in a company, right? Because it means that all of your effort, eventually, once the business blows and it gets acquired or it goes through, it gets sold on or anything else like that, you know that you've got shares within the business, right? So you have an invested interest in the business, and as an employee, it keeps you motivated, right? So I would probably suggest, as Sophie said, you have the split of the income, about 12,500 is what you earn. But beyond that, right? So it's almost like delayed gratification. What you can do is now, in any agreements that you have, is to have a share within the business, so that when it does flourish and when it does become a success or it gets acquired, you actually get to reap the fruits of your labor.
Thank you very much. And I believe last but not least, Harriet. And if I may just make a quick comment, in my experience, if you're going for investments, I think it's changing now for the better, but in my experience, VCs aren't the happiest people of you taking dividends, in terms of whenever you go to them to raise cash, dividends, and also direct loans. But again, hopefully that will change much sooner than it looks like it is. But at least it has started to change. Sorry, Harriet, go ahead.
Thank you. Yeah, I would agree with that. I'd say if you are actively seeking investment, I would be factoring in kind of modest but reasonable to cover your living expenses type salaries, and you know, presenting that in the financials, because that's going to be more palatable for investors. If investors aren't on the cards at the moment and you're fairly profitable, one thing I would add, and you know, everything that's been said is valid, but something that's now happening because the marginal rate of corporation tax has increased, and because if you've got multiple people on payroll, the employer's allowance has increased to 10.5k, is actually in some situations, because of the marginal rate, you know, kicking in after 50k of profits, to have your, you know, as employees yourself, is to actually up your PAYE salary, so even as high as the top of the threshold, so the 50,270, which is the top before you get into the 40% band, because you can offset that against the profit, which brings your corporation tax bill down. And so in some situations it's actually better overall to do that, but it will depend on how profitable you are ultimately, and if you're worried about, you know, the marginal rate, or if it's affecting you. So it's just one to bear in mind, that might be relevant for you as well.
Thank you very much, Harriet. And I just want to clarify something, because I got a message from somebody that is following this via YouTube. I personally do not advocate for founders not to take a salary. We've all got ourselves or our families to feed, so you definitely should get a salary. It's just that what I meant there is you should perhaps look into what are the best ways, because and to be honest with you, I am financially quite illiterate, as Samuel mentioned at the beginning, for some of us. So I'm not exactly sure why the preference for investors to try and stay away from dividends or director loans is, but maybe you can look into the PAYE way, or whichever is the easiest way. But I've just come across this a few times in the past. So I don't think we've got time for our third question, unfortunately. So please tune in next month, and I'll do my best to keep that question for next month. But perhaps in the 2 minutes that we have left, maybe our amazing panel would like to give us some parting words. So perhaps we can start in the same manner that they joined. So I think it was Harriet first, then Sophie, then Samuel, please.
So is this just a tip or something just to go away with? Sorry, I missed that.
Anything you want to tell us before you tell us where to go?
Okay, I would just say, this has been great with the questions coming forward. I'd say, ask all the questions. Sometimes people go off and do things and then tell you after, and we're looking for advice. So I'd say where you can, just like ask the questions, even if they might seem silly or confusing to you. Ask the questions, get some input early on, and it's going to be a lot less stressful in the long run.
Here, thank you very much for that, Harriet. Sophie?
My parting tip would be to have a really good look at how your clients, presumably if you have clients already, how they're paying you. I've seen an increase in financial instability in our own clients and our clients' clients. I think it's mounting, and just be, all the tips that Samuel said, I think were great. Get the options to pay by card, all that kind of stuff. Just don't let it waver. Be on your collecting your receivables, and keep an eye on how your clients are performing, because I think we're in for a little bit of a ride.
You can say that again, Sophie. Thank you very much, Sophie. And last but not least, Samuel, please.
Every founder wants to grow fast, right? That's something I've seen almost every founder I've worked with, right? But if you don't know your numbers, you'll be flying blind, right? So you don't need a finance expert, especially early on. But what you do need is visibility of your business. So important, right? So you need to track your cash, and you need to understand things. If it's SaaS tech, you need to understand your runway, and make financial decisions with intentions, right? With information and not an instinct. This comment that I feel that we should do that, and we feel we should. If you keep track of your numbers, you don't need to feel it anymore. You would know whether to take those decisions or not. So that's how you build something that lasts, right? So numbers, just make sure you're on top of your numbers. It's something I'm so passionate about. It's something I drive into all of the founders that I work with. And also, I just want to say as well, never had been on a panel with Sophie and Harriet, but I just want to appreciate them for their words of wisdom. Even in some of the things they've said here, I've actually taken some things away. So appreciate you both.
Thank you very much, Samuel. Thank you very much to Harriet and Sophie as well. Of course, I'm very grateful for your time and your gems that you dropped today. Really appreciate that. Hopefully we'll see you again. Just a couple of quick reminders before my parting words. Number one, please do remember we are unable to monitor questions live on our live streams, whether that's YouTube, LinkedIn, Facebook, or Instagram. So next time, if you do want to join us, please make sure you do that via our Microsoft Teams calls. You can RSVP to any future session via our site, startuptoscaleup.club, and then you look for your preferred Q&A. When you click join, it's a quick registration that gets you a link to your email to join our audio-only sessions. As far as those sessions are concerned, we run 6 regular events: Monday's talent, Tuesday's product and tech, Wednesday's growth, Thursday's fundraising, second Friday of the month is UK startup law, and third Friday of the month it's UK startup finances. They're all from 12 to 1 p.m. UK time. You can RSVP, as I said earlier, to any of them via our site. And actually, once you're there, you might want to join our WhatsApp community. There's groups of founders, investors, and operators like the amazing people we had on the panel here today. And as far as my parting words are concerned, just remember, the startup journey has its challenges, but also it can be fun. So, and exciting. So try to have some fun basically in the meantime, and be kind to yourself and everyone else for that matter too. Otherwise, have an amazing weekend and see you on Monday for Startup Talent Q&A. Thank you and God bless. Bye-bye for now.